Hi, so today we're talking about how the stock market works. Whenever you think about the stock market, just think market. And being a market, the stock market is a place that attracts buyers and sellers. In every market, there are people who want to buy something, and there are people who want to sell it to them. And in the stock market, it's the buyers want to buy stocks, the sellers want to sell stocks. Of course, there are other financial assets, we call them securities, that are also sold on the stock market. But we're not going to be talking about these for now. Let's just focus on stocks. So what is a stock? A stock or a share is simply part ownership or a certificate of part ownership in a company. Companies are divided into two types. You have private companies and public companies. A private company, as the name suggests, is just a company owned by a private individual or a group of individuals. In some cases, private companies are owned by another company. Okay, so another company can actually own another company. So when a company is owned by in its entirety by another corporate entity or by an individual, a group of individuals, it's called a private company. But private companies can become public companies. How? By a process we call an initial public offering. In other words, the assets, the shares of the company are offered to the public. The public get a chance to purchase a share in the company's assets, in the company's profits. When that happens, we say the company has gone public. Let me use examples just to help you understand this. Let's say that you set up a restaurant and your restaurant is doing really well. You want to expand the business. You have two options. You can go to a bank and get a loan and use that to expand the business, or you can seek investors. You can seek other people to join you, add their money to the capital that you've already invested in the company in order to expand it. Now, when other people offer you their capital, you must offer them something else in exchange. What do you offer them? A share of the profits. Okay? Now, how do they know that they're definitely going to get a share of the profits? Well, you issue them with a certificate that is binding on you. You can't renege on this. You have to follow through, and should you make profit, you have to share the profit with the investors who contributed to your endeavor. Okay, so those are the two ways in which a private company can become a public company. Now, Those are the two ways in which a private company, or a proprietor of a private company seeking investment, that's what they can do. They can either go to a bank or they can get other investors to join them. Okay. Now, in seeking other investors to join you as a business person, you have different ways of going about this. You can simply invite private investors to come and join you, or you can throw the net wider and invite the whole public to join you. Okay? So if you decide to throw the net wider and get the whole public to join you, that's when you talk about a public company. The company becomes public. In other words, it's publicly owned, no longer privately owned. It's publicly owned. And a publicly owned company is regulated by governmental authorities. Because think about it this way, whilst the company was yours, you had total control over it and you did whatever you wanted with it. But now that other people have put their money in, who's going to guarantee their interest? Who's going to safeguard their interest? There must be a third party doing that. Otherwise, things could go wrong, for example. So there are governmental bodies. In the US, it's called the Securities and Exchange Commission. In the UK, you've got a Financial Conduct Authority, and I think another institution that actually regulate these sort of affairs. So when you decide to join, when you decide to invest in a company, then the company has gone public and you've invested your money in it. From that time, you are a shareholder. When you're a shareholder, it means that you are entitled to a portion of the company's profits, also called dividends. And that's if the company does pay dividends. Not all companies pay dividends. And the company may not be paying dividends because they are not making profits yet, or they may be making profit but choosing to reinvest in the business to grow it. When a business as big as Amazon, for example, doesn't pay any dividend, instead Amazon uses that money to grow. And who's to say that it's a bad strategy? Amazon has grown faster than most companies that we know of. And the difference between Amazon's growth and other companies' growth is that for many other companies, it's just been a case of increasing the market share of the same products, or maybe adding additional, few other additional products. With Amazon, they have been expanding their business into multiple sectors. Amazon started off as a bookstore, an online bookstore. Today, it sells everything. It also has TV services. It also has Amazon Web Services. It's a cloud provider. All sorts of things that Amazon is getting into. Who knows, we're going to have Amazon Bank soon because there's Amazon Health and all sorts. So they've invested the money well, and because they've invested the money well, the company, or rather the investors, have been rewarded with the price of the Amazon stocks appreciating in value. So if you bought Amazon stocks back in, say, the mid-90s when it was going for 10 cents per share, today you're sitting on a pile of cash. Okay. So to recap, the stock market is a marketplace for stocks. And what is a stock, or what is a share? It is simply it's a certificate of part ownership in a company. Companies issue shares when they go public, when they try to raise funds, not from a bank or from private investors, but from the public. Anybody, any member of public, that includes you and me, can just go in and buy shares. In other words, invest in that company. The money is taken and then used to grow the business that issued the shares. When you buy the shares, you become a shareholder, which means that you now own part of the company. If you imagine the company as a pizza, the share is a slice of the pizza. Or if you imagine the company as a pie, a share is a piece of the pie. The company is, if you like, divided up into small pieces called shares, with each investor in one share getting one slice. Of course, if you buy 1,000 pieces or 1,000 shares, you get 1,000 slices of the pie, so to speak. So that's how it works. Thank you.